Brad Williams, Frugal Finance, Corporate Real Estate. When a corporation owns real estate, it reaps several benefits akin to those enjoyed by a pure investor. Take, for instance, the savings on lease payments that a corporate owner enjoys, similar to the income a landlord earns from leasing out space. Additionally, ownership allows the corporation to benefit from the tax advantages through depreciation allowances. Moreover, owning real estate grants the corporation the flexibility to sell the property in the future with the option to lease it back if needed. However, firms whose primary focus isn't real estate investments must weigh additional considerations. They need to assess the opportunity cost of capital tied up in real estate, how ownership affects financial statements, and the efficiencies of space utilization. These factors are crucial for making informed decisions. To begin, let's delve into how a corporate user should analyze whether to lease or own space required for its business operations. Lease-versus-own analysis. When it comes to acquiring space for business operations, corporations have the option to either lease or own. Owning space essentially means a corporation is putting its money into real estate. This investment can be financed through a mortgage secured by the property with a combination of debt and equity capital, or solely through equity capital. Conversely, if the space is leased, the firm can utilize it without tying up corporate equity. This flexibility allows the equity capital to be directed towards other investment avenues within the firm. The decision between leasing and owning hinges on whether the returns and risk of this alternative investment surpasses those associated with real estate, factoring in after-tax consideration. Leasing versus owning an example. Consider the scenario where the XYZ Corporation contemplates whether to own or lease real estate for its upcoming operations. Let's delve into an illustrative example. Suppose XYZ is eyeing the prospect of buying an office in a new market, projecting a potential boost in annual sales by $1.5 million, with the estimated cost of goods sold at 50% of sales and an anticipated $200,000 increase in corporate overhead, excluding office space expenses. XYZ would need to invest $1.3 million in office furniture and other initial costs associated with launching the new office prior to factoring in office space expenses. For exclusive corporate use, XYZ could purchase a small office building for a total of $2 million. Within this cost, $225,000 would be attributed to land, while $1.75 would pertain to building value. The building's cost would be depreciated over 31 years, XYZ operating in a 30% tax bracket. Alternatively, XYZ has received interest from an investor offering to buy the same building and lease it back to XYZ for $180,000 annually over a 15-year period. Under this arrangement, XYZ would cover all real estate operating expenses, an absolute net lease, expected to amount to 50% of the lease payments. XYZ predicts an increase in the property value over the lease term, potentially reaching $3 million at the end of year 15. Regarding financing, if XYZ opts to purchase the property, it could secure an interest-only mortgage of $1.3 million at 10% interest rate with a balloon payment after the 10th year. Cash flow from leasing. Table 16.1 illustrates how the after-tax cash flow is determined from opening the office building and leasing the space. Initially, there's an upfront cost of $1.3 million year zero to set up the office. Over the subsequent 15 years, as an after-tax cost, $196,000 is expected annually. It's assumed that at the end of the lease term, XYZ will close the office with no residual value remaining for the furniture and equipment. To evaluate the investment decision, an after-tax rate of return of 12.5% is considered as the opportunity cost or the rate at which the $1.3 million upfront cost could be reinvested. This rate accounts for taxes and can be compared with the returns from alternative investments of similar risk available to XYZ. This comparison helps XYZ determine whether investing $1.3 million in opening a new office building is the best use of its resources. We have this cash flow, our after-tax cash flow, then our internal rate of return, 12.5%. If XYZ is considering opening a new regional office, the next big question revolves around whether to lease or purchase the property for housing the new operation. One approach is to tackle this decision is by crunching the numbers on after-tax cash flows and the after-tax return, assuming ownership of the space instead of leasing it. Cash flow from owning. In table 16.2, we observe the after-tax cash flow stemming from the assumption of owning the office building. The initial cash outlay amounts to $1.7 million, which covers both the equity invested in the building, $431, and the upfront cost, $1.3 million. Over the first 15 years, the after-tax cash flow sums up to $241,170 per month, with an additional after-tax cash flow from the sale of real estate standing at $1,046,000. The calculated after-tax internal rate of return under this scenario is 12.95. Interestingly, this return slightly outperforms the after-tax return of 12.5% if XYZ opts to lease the space, as detailed in table 16.1. This indicates that owning might be the preferable route. However, it's crucial to note that the 12.95% rate of return encompasses both the funds invested in opening the office building and the extra equity injected into owning the building, $431. Essentially, this rate of return reflects the combined investment decisions of one, launching the office building, and two, possessing the building. While the rate of return associated with owning the office building surpasses that of leasing, it's essential to consider that the associated risk might also be higher, contingent upon the risk tied to holding the real estate as an investment. To delve deeper into this assessment, we need to isolate the after-tax rate of return linked solely to the investment in real estate. So here are the numbers I noted earlier. You can go back, you can review them. I probably did not reconcile all of this. Yeah, I might have. Here in the end, we have this cash flow. We have this outlay of $1.7 million, $241 annually, generating an internal rate of return of 12.95. If we look at this table, lease versus own analysis, we're going to see this. I don't know where this 1379, because I thought they stated it was 12.5%. You can calculate this information and confirm. Lastly, we have the sales leaseback, and it generates internal rate of return of 14 points. What I want you to do is crunch these numbers and verify. Then we're going to go to the next tutorial. We're going to elaborate a little more on this decision. Brad Williams, Frugal Finance. Thanks for watching.